Hey everyone, it's Tony Leonardi, CFP professional and author of A Smarter Way to Retire, back with another episode of A Smarter Way to Retire podcast. This past week brought fresh CPI reports, some market swings, and more tariff tensions. So how do these affect your retirement? We're going to break it down today and share some steps to help protect your financial future. Plus, the first 10 Connecticut residents booking with me in August get a free retirement plan using our MoneyGuidePro software to help calculate your probability of success. Before we get into any of that though, I'm looking out at my garden out of my office window. It's the middle of August. The garden is really starting to move into high gear after a slow start this spring. The tomatoes are starting to pop and some are starting to change color a little bit. We have pumpkins growing all over the place. The green beans and the cucumbers have been doing great. We're waiting for some peppers to come out. It's our second year with the garden, so we're still learning on the go, but things seem to be working out pretty well. We might need a little bit more sun in the area where our garden is, and maybe that's why we seem to be a little bit behind schedule. Maybe it's a lack of sunshine. Right now the garden is fully enveloped in sun, but I'm not sure that it gets enough in terms of hours per day, so I'll have to keep an eye on that. If there are any gardening experts out there, maybe you can let me know the secret to a good garden. Either way, we're having a lot of fun with it, and we love the fresh vegetables. Also this week I made another loaf of fresh sourdough bread and 3 quarts of fresh homemade yogurt. They're both very easy to do, and along with the fresh vegetables from the garden, it ensures that we're getting fresh homemade food pretty much all week. I'm a little particular about what I eat. I like to read labels when I buy something that's packaged. I try not to buy too many packaged foods, but with the fresh vegetables, the sourdough bread, and the yogurts, I'm certainly getting a lot of good quality homemade stuff. So if you're not making bread or yogurt and you want to learn how, reach out to me. I'll give you my recipes. It's actually pretty easy. This week there was some new inflation news with the Consumer Price Index report for July. And it's a big deal for your retirement. The Bureau of Labor Statistics reported a 0.2% month-over-month rise in headline CPI, which tracks overall consumer prices, including gas, food, and housing. And that was hitting about 2.7 year-over-year steady from June, but also below the 2.8 that economists were expecting, and that's great news. I think economists were expecting at this point in time that tariffs would have pushed inflation up quite a bit, but we're not quite seeing that yet. I guess we'll have to wait for a few more months to see what happens, but for now, inflation seems to be holding steady. Core CPI, which strips out food and energy, I'm not sure why they take that out, food and energy, that seems very core to me. But core CPI climbed 0.3% monthly, and it's at 3.1 annually, a little bit above the 3.0 forecast by economists, and the highest since February. Shelter costs were up, housing was up 0.2%, and that was one of the main drivers, making up about a third of the index. While energy prices actually fell 1.1%, led by a 2.2% drop in gasoline, according to BLS data. That's great news for consumers. Food prices were flat, also good news for families and consumers. Eating at home dipped by 0.1%, that's grocery costs, but dining out rose a little bit, 0.3%. The markets loved all this news, hitting record highs as investors bet on a September rate cut, with odds now at over 90% for a rate cut in September, according to CME FedWatch. The question now is, will we get a quarter-point cut, a half-point cut, or will Chairman Powell hold again to sort of highlight his independence from Washington, D.C. pressures? Interesting to keep our eye on. For your retirement, lower headline inflation is good news for keeping costs down, but rising core inflation means healthcare and housing could eat into your savings over time if you're not prepared. Beyond CPI, markets were a roller coaster this past week. On August 6th, stocks slid. The Dow was down about 1%. The S&P was off 0.4%. And this was due primarily to fears over the 50% tariff hike on India. The president is trying to stop India from buying Russian oil so that Russia doesn't have the funds, the money to fund the war with Ukraine. This is according to Yahoo Finance. On August 7th, the market rebounded. S&P was up 0.7, Nasdaq was up 1.2, fueled by Apple's AI bets. Apple's betting big on AI in 2025, rolling out features like live translation for messages and FaceTime, and smarter Siri, which would be great, with on-screen awareness and visual intelligence for screen-based searches. They're also investing $500 billion acquiring AI startups and building a new AI server chip called Baltra, according to Forbes. August 8th brought a 224-point drop in the Dow, per CNBC. Tariffs also sparked EU trade threats. Some analysts say U.S. small caps could benefit, according to Forbes. Earnings from Uber and Disney beat expectations, lifting consumer stocks, while oil futures and treasury yields dipped amid trade uncertainty, according to the Wall Street Journal. It's been a busy week overall, a lot of moving parts. For your portfolio, this volatility screams the need for balance, for diversification. Don't put all of your eggs in one sector like tech or materials or AI. Don't chase the hot stocks or the tips from neighbors and friends. Stick to your plan. If you don't have a plan, you should. If you don't have one, let me know. So how do you plan for a smarter retirement with inflation, with tariffs, and market swings in play? Here's your playbook. First, combat inflation with tax-efficient strategies, especially with core inflation at 3.1%. Have you evaluated the impact of Roth conversions on your probability of success? Probably a good idea. Second, diversify your investments to hedge volatility. Consider small cap ETFs for tariff upside and bonds for stability. Even international ETFs or mutual funds to provide some diversification away from domestic stocks. Third, use MoneyGuidePro or some similar software to stress test your plan for inflation spikes or trade war risks, calculating your probability of success. If you don't know your probability of success, you should. Let me know. We can calculate that together for you. If you own a business or rentals, explore deductions to offset rising costs. And don't procrastinate. The first 10 Connecticut residents booking with me in August get a free retirement plan using our MoneyGuidePro software to help measure your probability of success. Spots are filling fast, so act now. There's a link for my calendar on my website in the contact section. Look for Calendly. That's my calendar software. That's it for this week's A Smarter Way to Retire. I'm Tony Leonardi, CFP professional, here to help you navigate inflation and market chaos and to help you build a plan towards success. Follow us on Instagram at Tony Leonardi CFP and Facebook at Leonardi Family Wealthcare for more tips. Subscribe on Spotify, Apple Podcasts, or YouTube. And leave a review if you found this information helpful. Don't forget to book your free consultation. On my calendar, look for the Calendly link at leonardifamilywealthcare.com. Only 10 spots available for August. Plan smart, retire happy, and we'll see you next week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.